Okay, let's jump right in. Zebra Technologies, ticker ZBRA, they actually beat expectations in Q3 2025. EPS $3.88 versus the $3.73 forecast. Revenue $1.32 billion. Good numbers. So why on earth did the stock plummet? Down like over 16%.
Yeah, it's a classic case of the market looking right past the now and zeroing in on the what's next, and frankly, getting scared. So our mission here is to unpack exactly what spooked investors in that forward guidance.
And then figure out if maybe, just maybe, the market's overlooking some big strategic plays, like their AI push and these acquisitions.
Exactly. Are they missing the bigger picture?
Okay, let's start with Q3 itself because, I mean, operationally, things look pretty solid. Non-GAAP EPS, $3.88. That's a beat by, what, over 4%?
Yep, 4.02% beat. And revenue, like you said, $1.32 billion, up 5% year over year. They really executed well in the quarter.
Especially on profitability, right?
Right. Absolutely. That adjusted EBITDA margin, it ticked up to 21.6%. Now, for you listening, EBITDA, it's a core profitability measure, basically earnings before interest, taxes, depreciation, amortization. Getting that up 20 basis points.
At 0.2%.
0.2% in this kind of cautious environment. That shows they've got a good handle on costs, maybe some pricing power too. It points to, really robust operational health.
So if the operation is humming along nicely, why the 16% shellacking on the stock? I mean, it just feels irrational to punish a beat like that.
Well, it tells us a couple of things, I think. First, investors clearly see Zebra as, like, super sensitive to macroeconomic fears. It's kind of a proxy for tech spending in industry and retail.
Right.
And the data backs that up. Investing Pro shows its beta is 1.75. That's high. It means when the market gets jittery, ZBRA stock tends to move almost twice as much. So they were punishing the uncertainty they see coming.
Okay, that's one thing. What's the second?
The market seems convinced there's a real slowdown in organic growth coming. We'll definitely get more into that with the guidance details.
Right.
But here's the weird part, the disconnect. Even after this huge drop, that 16% hit, Investing Pro's analysis, it actually suggests the stock is undervalued based on their fair value calculation.
Undervalued after falling that much. But hold on, if the fundamentals are solid and it's undervalued, why aren't big investors just piling in to buy that dip? That suggests the market sees something really genuinely scary in the outlook that outweighs the good Q3 numbers.
That's the tension, right? That's what we need to dig into. Right now, it feels like the fear of a potential recession is winning out over the company's proven ability to execute.
Okay, let's talk about that uncertainty the execs mentioned. They said customers are navigating an uncertain macro environment, uneven demand. So where did they do well geographically in Q3 and where was it weaker?
Yeah, it was really a tale of two halves of the world almost.
Right.
Geographically, Asia-Pacific was on fire, up a massive 23%, mostly driven by Australia, New Zealand, and India.
Wow, 23%.
And Latin America also had a record quarter, broad-based growth there, up 8%. So strong performance in those regions.
So the East is buying strong, but what about Europe?
That was the soft spot. EMEA, that's Europe, Middle East, and Africa sales, actually declined 3% overall. It was mixed within Europe, though. Northern Europe held up okay, but Germany was noticeably weaker.
And what about industries? Any particular vertical standing out, good or bad?
Well, retail and e-commerce seemed okay, but manufacturing demand was still kind of soft. And healthcare revenue, well, they said it faced a difficult comparable.
Okay, hang on. Difficult comparable. Can you just break that down quickly for listeners? What does that mean in simple terms?
Sure. It just means that healthcare sales last year in the same quarter were unusually strong. Maybe there was a big one-time deal or a system upgrade cycle peak then. So even if sales this year are decent, comparing them to that super high number from last year makes this year's growth look weak or even negative.
Got it. So it's more about the comparison point than a sign that healthcare demand suddenly collapsed.
Exactly. It's an optical thing, mostly. Doesn't necessarily mean the underlying business is falling apart.
Okay. Let's look at their two main product divisions then. Asset Intelligence and Tracking, AIT, and Enterprise Visibility and Mobility, EVM. Which one held up better against this sort of mixed backdrop?
AIT was definitely the star performer operationally. It grew strongly, 10.6%. That segment includes things like their printing solutions and, importantly, RFID technology.
Okay.
EVM, that's the bigger segment, mobile computers, scanners, things like that. It grew, but only modestly, about 2.0%. Within EVM, mobile computing did well, but scanning had one of those difficult comparables we just talked about, which offset the growth.
Right. So RFID, that's radio frequency identification, keeps coming up as a strength. You said it's part of AIT. It's been growing double digits for years now, apparently. Why is it suddenly expanding into places like fresh grocery or manufacturing?
Well, it's because RFID solves really fundamental problems that are just getting more critical for businesses. Things like knowing exactly what inventory you have and where it is in your supply chain. Yeah, as companies try to run leaner, maybe hold less inventory to save cash, and deal with complex global supply chains, the value of knowing exactly where everything is,
Yeah.
it just goes way up. The ROI becomes undeniable.
So it's almost like a necessary tool now, regardless of the macro worries.
Kind of, yeah. It provides that really crucial visibility.
Yeah.
It helps make that part of Zebra's business feel more durable, maybe more defensive,
Right.
even when customers are being generally cautious.
All right, let's get to the heart of the market reaction, the outlook, the guidance. For Q4, they projected sales growth between 8% and 11% year over year. Now, on the surface, that sounds pretty good, right? Double-digit potential. Why did the market hate it so much?
Because investors look straight through that headline number and focus entirely on the organic growth, or, well, the lack of it.
Ah,
The company basically confirmed that acquisitions, specifically Elo Touch Solutions and Photoneo, these companies they bought, plus some favorable currency exchange rates, those things together are expected to add about 850 basis points.
so 8.5 percentage points.
Right, 8.5% of that 8% to 11% Q4 growth outlook comes just from acquisitions and FX. It's not from their core existing business selling more stuff.
Okay, so if you strip out that 8.5% from the 8% to 11% total growth forecast, you're left with maybe 0% to 2.5% organic growth year over year. That's the slowdown the market freaked out about. A signal that underlying demand might be stalling because customers are tightening their belts.
That is precisely how the market read it, yes. Even though their full year 2025 outlook still looks pretty decent, they're expecting 8% sales growth for the whole year. 17% non-GAAP EPS growth. Investors reacted really negatively to that near-term organic picture. It looks like they're having to buy growth right now through M&A.
Let's talk about those acquisitions then, the ones propping up the Q4 numbers. Elo Touch Solutions, they make self-service kiosk, point-of-sale stuff. That seems like a significant buy. How does that fit into their bigger strategy? They talk about the connected front line.
Yeah, the Elo deal looks like a major strategic move. It's supposed to add around $100 million in revenue just in Q4 alone, and it immediately pushes Zebra much deeper into that whole self-service market, which is growing fast.
So expanding beyond just scanners and printers.
Exactly. They're aiming to massively increase their total addressable market, talking about over $20 billion in this segment. They want to combine their own mobile computing strengths with Elo's kiosks and POS systems to offer, a more complete solution for those frontline workers, control more of the tech infrastructure end to end.
Okay, so M&A is one pillar. The other big long-term bet, the CEO Bill Burns really emphasized this, is artificial intelligence. AI. He's talking about AI driving the next big tech refresh cycle, like previous shifts. What's the actual plan there, and how long will it take?
The core idea is to embed AI capabilities pretty much everywhere on the devices themselves, in the cloud, to automate tasks and really change how frontline work gets done. They're hoping this creates demand for a whole new category of higher-end premium devices.
Because the old ones won't be powerful enough.
That's the bet. That AI software, like their Zebra Companion agent, will require customers to upgrade their hardware to handle the processing the connectivity demands.
But the timeline, that seems to be testing investor patience, doesn't it? They're saying first real AI revenues might not show up until 2026 and then ramp up more in 2027 and beyond. That's like a 2 to 3 year wait. Isn't there a big risk AI takes longer to catch on or competitors beat them to the punch?
Absolutely. That time lag, that inherent risk, is a big part of why the stock got hit so hard.
Yeah.
The market always prefers profits now. But Zebra seems aware of this. They're trying to mitigate that risk by running pilots today.
Okay, what kind of pilots?
They mentioned working with retailers using AI for things like product recommendations on the shop floor, and with big logistics companies using AI on devices to speed up proof of delivery documentation. They're trying to build the business case now, show customers a tangible return on investment to justify that eventual upgrade cycle.
Okay, makes sense. Let's shift gears slightly. Risk mitigation. Tariffs have been a persistent headache for companies importing from China. What's Zebra doing about that?
They have a pretty clear plan, actually. They aim to significantly reduce the impact of U.S. import tariffs by 2026. Two main levers. First, drastically cutting the percentage of U.S. imports coming from China down to less than 20%. Second, implementing price adjustments.
Raising prices, basically.
Essentially, yeah. And they reckon that pricing strategy alone should add about $60 million a year in revenue, or about 1% of sales growth. So it's a methodical approach to de-risk the supply chain and protect their profit margins.
And finally, they're also signaling financial strength, right? Which seems important given how volatile the stock is and how nervous the market seems.
Definitely. And their underlying financial health looks, frankly, exceptional. They highlighted a perfect Piotrowski score of 9. Now, for listeners, that's a score out of 9 that checks various measures of profitability, efficiency, financial leverage. Getting a 9 is top marks. Really strong fundamentals.
And they're using that strength how?
By giving cash back to shareholders. They announced plans to buy back $500 million worth of their own stock over the next year through Q3 2026. That's a pretty strong signal from management saying, hey, we think our stock is cheap and we believe in the long-term value, even if the market is freaking out right now. Hashtag outshag outro.
So when we pull back, we see this really clear picture, right? Strong Q3 performance, operationally sound, a clear long-term strategy focused on growth through AI, through smart acquisitions like ELO, and returning cash to shareholders. But all that is clashing head-on with this immediate market panic over flat organic growth in Q4, driven by that uncertain macro picture.
Precisely. Zebra is trying to push into these new, bigger areas, connected frontline asset visibility, automation aiming for like 5% to 7% organic growth over the long haul. They beat Q3 earnings, and the Q4 guide, while organically flat, does suggest spending might be stabilizing towards year-end.
So the big question, the one for you to really chew on, is this.
Is the market's reaction just crushing the stock 16% a rational response to genuine near-term economic worries? Or is it possible that investors are seriously underestimating how powerful this AI-driven refresh cycle could be? Could it fundamentally shift Zebra's growth trajectory starting in 2026, maybe even sooner than they expect if those pilots really take off? That's the billion-dollar question, isn't it?